I'll show you how to set up and start investing in your own dividend ETF portfolio in this video. By the way, don't forget to like this video and subscribe to the channel before I lead you through the process. I'd like to start by discussing some of the benefits and drawbacks first of dividend ETF investing. The first benefit is that dividend investing offers you passive income. In fact, I would argue that dividend income is the most passive form of income available because all you have to do is go to your broker, buy some shares of a dividend-paying stock or ETF, wait 3 months for it to pay you, and then collect the income without doing any work at all. And some companies even pay monthly dividends. Benefit number 2, dividends reduce your portfolio's risk and volatility when you invest in growth stocks. Amazon, Tesla, and Coinbase, to name a few, are all considered growth stocks. When you engage in these, your portfolio becomes riskier and more susceptible to large swings up or down, which isn't always the case when you invest in dividend stocks or ETFs. Dividend stocks have a reputation for being less volatile than growth stocks, despite the fact that they expand at a slower pace. Furthermore, dividend investors don't lose money as quickly as other investors during bear markets, since dividend stocks tend to decrease more slowly, and on top of that, dividend stocks pay dividends. This implies you'll continue to receive dividend income even if the stock's value falls. Benefit number 3, dividends provide tax benefits. Dividend income is treated differently by the IRS than other types of income, such as money earned from a day job. Compounding returns occur when a dividend-paying company, or ETF, pays you a dividend, and you take that payout and reinvest it in more dividend-paying stocks or ETFs, and you do this over and over again for years. This is what will allow you to develop your portfolio and wealth dramatically over time. When you reinvest your earnings regularly over time, your portfolio will grow at an exponential rate as the years pass. Now, let's look at the drawbacks. First drawback is that dividend-paying stocks aren't known for their explosive growth. If you look at some of the fastest growing stocks over the last decade, you'll notice that none of them are dividend stocks almost every time. Instead, growth stocks from businesses like Tesla, Amazon, and Shopify have outperformed the market. These are all companies that don't pay dividends because they prefer to reinvest their profits back into the business to keep it growing. On the other hand, some of the finest dividend-paying businesses such as Coca-Cola and Johnson & Johnson pay dividends to their shareholders and hence are unable to reinvest much of their profits back into the business. As a result, the company grows at a slower pace and the stock price follows suit. This means that if you truly want to prioritize growth above dividends, you should avoid dividend-paying stocks and ETFs because they will not rise as quickly as a growth stock. The second drawback is that the payments of dividends are never guaranteed. Just because a firm gives you a dividend today doesn't mean it's obligated to pay you another one tomorrow. If a company is experiencing financial difficulties or is not producing enough profits to pay dividends to its shareholders, it may temporarily suspend or even eliminate its dividend entirely. Disney is an excellent illustration of this. Disney has been paying dividends for 40 years and had a track record of growing them. But during the coronavirus pandemic in 2020, the corporation canceled its payment completely. So now I want to shift gears and go over how to begin a dividend ETF portfolio. Before this, don't forget to hit that like and subscribe button for more valuable information coming your way. Now is the time to open your new brokerage account, which will be used to start building your dividend portfolio. Before you do anything else, you'll have to pick a broker. There are many wonderful brokers to select from, but here are a few of the best in my opinion. Vanguard, Fidelity, Webull, and M1 Finance, to name a few. Choose the one that best suits your needs. In general, older brokers like Vanguard and Fidelity will have more investing options such as mutual funds and CDs, but they will also be exceedingly clunky and archaic. Newer brokers such as Webull and M1 Finance, on the other hand, will have fewer investment possibilities, but will be much easier to use and will have a sleek and clear user experience. You can also invest in crypto with Webull, though you can't go wrong with any of these brokers. If you only want to invest in stocks and ETFs and don't want to mess with mutual funds, options, or CDs, any of these brokers will suffice. The next step is to decide which type of account you want to open. Now, most of you who are watching will probably just use a standard brokerage account. If you want to start a dividend ETF portfolio on your own, you can register an individual account, but if you want to share ownership with someone else, such as a spouse or significant other, you should open a joint account. The entire process takes less than 5 minutes, and each of the brokers I propose in this video will follow identical steps, so keep that in mind. You'll normally have to enter your bank account number and routing number, and then you'll be able to see your bank account display after that. You can now transfer money into your brokerage account after you've linked your bank account. You'll usually have to wait 1 to 2 business days for the transfer to complete, and then the money should reflect in your brokerage account. You can then begin investing in dividend ETFs once the transfer is complete. After that, you'll be ready to begin picking. Which dividend ETF do you want to buy? Let us know in the comment section down below. Because we're primarily seeking dividend ETFs, you'll want to navigate to a page where you can locate dividends. This is where you can see a ranking of the best dividend ETFs to invest in by total assets. The ETFs can usually then be sorted based on several characteristics, such as the yearly dividend rate, the actual payout, or the dividend yield. However, you should exercise extreme caution when investing in ETFs, especially those with high dividend yields. While this may seem appealing, these are known as dividend traps. A dividend trap occurs when you're attracted into purchasing a dividend stock by its high dividend yield, only to discover later on that the underlying firm is not a good company at all since it's not putting any of its money back into growing its business. They're simply handing it off to investors. Furthermore, this company may be providing a very high dividend yield in order to entice inexperienced investors who don't realize that this is a terrible company to invest in. As a result, only look for companies that pay a high dividend while also increasing in value over time. You should also search for an ETF that provides diversification as well as the cost of ownership, 10-year average return, and of course, dividend yield. It's now time to buy your dividend ETFs once you've made your decisions. Most of the time, all you have to do is click buy or trade. So let's take a quick look at what all of this means, since if you're new to investing and have never used a broker before, this may all appear to be rather confusing, but trust me, when I say it's a lot easier, it really is easier once you get started. Depending on the broker, you'll likely have options in an order entry window or a trade window. This is where you'll find the trade option, which is often found in a broker like Fidelity and allows you to select the type of investment you wish to make. Stocks, ETFs, options, mutual funds, fixed income, and a variety of other choices are available. We're only going to stick with stocks and ETFs for this video though. If you have multiple accounts in one broker, which is possible with Fidelity, and you want to manage them all at once, use the account drop-down menu. You can then choose to make a trade or an investment from the account of your choosing. Normally, you just select the account you want to invest in from the drop-down menu. Most of you watching will probably only have one account if you're new to all of this. And then you'll see how much money you have available to invest. The next thing we'll look at is the ticker symbol. This is a 1 to 4 letter combination that's used to check for the stock of a corporation. Tesla's ticker, for example, is TSL. And if you type that into your brokerage's search engine, Tesla will appear. Following that, you have the option to buy or sell. This is rather self-explanatory. If you want to buy a stock or an ETF, make sure the buy option is selected. And if you want to sell, make sure the sell option is selected. The terms shares and dollars refer to 2 distinct ways to purchase stocks or ETFs. You can indicate whether you want to buy 1, 2, or maybe 3 shares of a stock, and you can even have your broker calculate how many shares of a stock or ETF you can buy based on the amount of dollars you've put into your account. After that, we'll look at order and limit order. These two are significant, but for us long-term traders, knowing the difference between them isn't critical. So you'd simply click on the market order because you want your order to go through and fill as quickly as possible. After that, carry out the command and you're done. Now, whenever you want to acquire more shares, all you have to do is go back to your brokerage account, log in, and repeat the process. And that's all there is to it. As you can see, investing doesn't have to be this complicated process that's only available to a select few people, as you've just witnessed. It's incredibly simple to set this up and start investing for yourself, so you can start growing your money and your future so you can have the long-term riches and legacy wealth that I know you want. If you like this video and haven't yet subscribed to the channel but appreciate similar content, well then it's now time to subscribe to the channel and leave us a like. See you on the next video.